from Alpha Trends. Thanks for joining me on this Friday afternoon for StockTwits TV. Let's go ahead and take a look first at the S&P 500. We've got a big level here at 111.80 that this market keeps trying to get through, but refuses to hold above there. The good news is that overall, though, it does continue to hold up, and we're in a solid uptrend overall. And for people that are looking for the top here, the evidence just isn't there yet. All day today, we've had a solid advanced decline line. It never went negative all day, and the market didn't go negative, I don't believe, either, if I remember correct. I guess it did. That's not true. It did slightly. But the point is, the advanced decline line, very solid, 20 to, basically 20 to 10 or 2 to 1 advancing stocks to declining stocks. So we've got a pretty broad-based rally here today. Right now, the market's doing battle with that daily VWAP. So we're up on the day about 72 cents right now, or about 2/3%. And market's trying to get back above that daily VWAP at this point. We had a spike low down to about 110.02, I think was the level, and then a test of that level, and since that we've experienced this bounce here. So when we look at the 30-minute time frame, this is that 111.80 level that now 3 times in 3 days we've popped above that. We've actually made higher highs above that level as well, and some people might want to call it a broadening megaphone, or all kinds of technical patterns. But rather than trying to memorize patterns or place a name on what a certain 3-day event is, it's more important to take a look back at the bigger picture and say, what's the trend here? We've got a rising 10-day moving average, a rising 20, and a rising 50-day moving average. You look at the weekly time frame, we're at a very important level here. This is a level that we've been talking about for quite a while. We did get up through that 50% retracement. The exact number, which these aren't exact things anyways. Technical analysis, as they say, is an art, as is trading, as is science, as is fundamental analysis. You can't just buy stocks with a 10 PE. There's extenuating circumstances for any form of analysis that we do. So if you take a look at the longer term time frame, though, we are at a level that's getting a lot of attention for 2 reasons, basically. One, it's the 50% retracement of the 2007 high to the 2009 low. So this would be a 38.2% retracement right here, and the 50% retracement. A lot of times people look to slow down their purchases in that area. Other people offer their profits, profitable positions out at that level, and it becomes a self-fulfilling prophecy. Well, when you have any analysis, any technical analysis you do, if you can draw the same conclusion for more than one reason, it adds validity to that area. Meaning, we also have this downtrend line from the 2007 highs and the 2008 highs as well, where we can see here that we're now touching on it. Will this be the 2009 high? Maybe it will, but we won't know in hindsight. For now, it's a level that is getting a lot of attention. It's getting a source of supply maybe from people who are looking at Fibonacci and saying 50% is a good place to take profits, or 50% is a good place to slow down their purchases. And it's also getting supply released to this area due to that trend line. There's a group of people out there who are looking at that trend line saying, I'm not going to buy because it's at that trend line, and that's resistance. Well, we don't know what resistance is until after the fact. What this market might do is we might pull back, but then we might go back up towards the 61.8% retracement and this big prior level of support. That's still doable at some point. Is it realistic? What's realistic and what's not realistic in the market. The only thing that's real is what you see each day. And if you came into this, yesterday afternoon, we saw a pretty fearful decline, and we came down to this prior level where we've had, the 110.40 to 110.50 level. Let's take a look at that actually in the 30-minute time frame. You look at this 110.40 to 110.50 area, you can see it's basically the midpoint of what's been a pretty neutral market lately. Pretty much from, we could call it 111.80 down to 108.75, 109. Of course, we had this little Dubai gap lower through there. And if we take a look at, the prices since Dubai, we take a look at a volume-weighted average price trend line, and we can see here that now we're back above that level, and it's actually right about where that 5-day moving average is. So for the week, we're actually almost unchanged for the week, I guess. At this point, we had closed. Was that I don't know, 1, 2, 3, 4, 5? So we're actually up on the week. So we're up on the week, and people are looking for the top of this market, but there's just no sign of a top. There's reasons to think that, okay, we're at an inflection point, we're at an area that gets a lot of people's interest, so maybe we look for selling, but the top just hasn't presented itself yet. So enough about the S&P 500 for now. Let's take a look at the financials. The financials are the one group that people have been looking for the death of for most of the year, but it just refuses to roll over and die for more than maybe a week at a time or so. This daily time frame, it's really pretty neutral. I mean, I've been telling subscribers for the last few weeks that basically, unless you're a day trader, these financials are pretty much a waste of time. They've I shouldn't say that, because I'm sure there's people that are going to say, well, I've had great swing trades and that sort of thing, and there are some good ones. But overall, if you look at this market, since it broke out right in here, the volume weighted average price, we're right there, right in the middle of that range, 1460 or so. And recently, the important level for this market has been this $14.55 level. But it's an important battleground, but it's not a battle where anyone's making any progress. It's just a bloody battleground. But there's casualties on both sides who are playing north and south of 1455, because if you're shorting these breakdowns, yeah, they're good for quick trades, but then you get punched right in the face early in the morning. If you cover that short, then you get that decline once again, and now we're back up through it. So it's really just a back and forth chop fest in these financials. You look at this 30-minute time frame that goes back about a little more than a month, and we've really been trading in a pretty tight range. I mean, especially since the November 9th level, we've basically been 1420 to 1510, and that's not much of a range at all. So I think there's probably too much attention on these financials for now. You can't deny the fact that we've got a declining 50-day moving average that seems to be acting as resistance in here, but we've got these 10 and 20-day moving average crossing back and forth. Just a whole bunch of indecision in here for the financials, and I think there's too much attention being put on them. The Nasdaq is close. It had come close this week to closing at new highs. We did make I believe, let's see, this intraday high was 44.60. Today's was 73 cents. So we did make an intraday high. We've got heavier volume today. We've got a red candle, and people will tell you, that these candles mean something, but these one-day candles really don't mean much. What you want to do is focus on what's the trend of the market. Well, the trend of the market is clearly still higher. We can look and say, well, we're up against resistance. This is a level where we've seen support. Now it seems as though we're slowing down in here, but people were calling this resistance back 3 months ago, and the market barely slowed down going through that level. So those are potential levels of resistance. You seen the trend line in the Nasdaq have kind of come together at that same point, but the market blew right through that. So maybe that's what the S&P 500 is going to do. It's going to blow through its trend line in that. We have to just look at it and say, overall, the trends remain higher. We're in healthy uptrends for the most part. Even the financials, if you look at the weekly time frame, we're still in an uptrend here. We've got a rising 10, 20, 30, 40 week moving average. It's really going to take a move below about $14 a share to change that, and even then there's the potential for bigger support down near these levels from earlier in the year that we broke out from at about $13 a share, and that's where we're going to find that rising 200-day moving average as well. The one group that really has annihilated more shorts than anyone else this year, I think, is IYR, the commercial real estate. A lot of people a lot of smart people had been saying this is the second shoe that's going to drop, and maybe one day it will eventually, but not while the trend is higher. They just don't fall out of bed that quickly. We have to see evidence like we saw back in here. The moving averages begin to cross. They begin to turn lower. The longer term, the 200-day moving average flattens out, and begins to turn lower. And when the direction of the 200-day moving average is lower, rallies are guilty till proven innocent. When the 200-day moving average is flat, it's more neutral, and when it's rising, it's innocent till proven guilty on the longer-term time frame. What you have to do is define which time frame you trade on. So, as far as people saying bull market, bear market, those are all just generalizations that mean nothing, and it has to be relative to what's your position. If you just shorted the S&P 500 here off the VWAP, well, we're in a bear market and you're making good money, so that's what's important to you, and that's what your focus should be. The Russell 2000 has had a great rally from the Dubai lows, been the strongest group there is. This is the market that's been left for dead, and I've been telling people that I think there's a pretty reasonable chance that we might be able to see new highs in the IWM, or tie those highs up near 62.50 this year, because the market loves to do what the least amount of people expect it to do. We can look at this and say we have these higher low in here. Now we're up towards this 60.5, 60.70 level that we did pierce briefly today, but you can't buy breakouts after a 5-day rally. That doesn't make sense. But if you look since Dubai low right here, you can see the average price at about $59. Earlier on a midday video, I told subscribers I thought that as long as we hold above $59.50, then the Russell is still in pretty decent shape. And so far it's holding on these gains. It's got a rising 5-day moving average, so I think intermediate term you have to look at the Russell as innocent until proven guilty. There's a lot of people who are short these the Russell. I see that the volume is low, hard to hear. Sorry, I just took a look at that for the first time, so I'll speak up a little bit. I don't know. Let me see if I can do something here real quick with this microphone. I think I just did something. I don't know if that would work or not, but anyways, I did just turn up some kind of volume on my screen here. And this is a new computer. That's why we haven't shut down, by the way. Anyways, the Russell still, to me, Russell looks amongst the better groups right now with this rising 5-day moving average, the higher highs and higher lows. So you have to look at these headlines and look at them and say how valuable are they? When we look at it, price is what matters most. The semiconductors are up at new highs for the year. They're going to close on a weekly new high. This is a group that appeared to be breaking down a week and a half, 3 weeks ago, 4 weeks ago, but they recovered quickly. And it's the same type of story. You don't sell short after a 3-week decline. This was the Intel news right here, the Intel earnings, that is. And anyways, someone let me know if that volume is any better, because I'm not seeing any feedback about that. But since the Intel earnings, the market pulled back, looked to be breaking down, rallied from there. Now we've got it up at new highs here for the year, and people are looking and saying, well, we have this prior support, which is resistance. We don't know if it's resistance. Right now, there is zero evidence of resistance in this level, because this market is rallying higher. We're not at the highs for the day, but we are above the daily VWAP. The S&P is not, so it's outperforming in that regard. It's also outperforming on a percentage basis because it's up 1.3%. The Russell today, by the way, is up 2% right now, and the financials up 1.3%. So I still don't understand the bearish case. I think we have to be alert for signs that maybe the sellers are taking control, but the signs aren't there yet. The biggest reason for worry is the financials, but again, they're really more neutral than anything. While this market is turning neutral, is it sucking in new shorts before it begins its next leg higher, or is it just going to completely fail? Well, anyone that tells you that they have any information that the market is going to rally or the market is going to break down, basically they're full of shit. Nobody knows what the market is going to do. What we have to do is we have to look at it and look at the evidence that it gives us each day. Thanks, Joe. I don't know why that would be with the volume. I've got the microphone right up next to my mouth. But anyways, you have to look at it day by day and understand, what is your view? What is your time frame, that is? Gold getting hit a little bit in here today. I mean, you could as well getting hit a lot, down 4.5%. But relative to the rally it's seen, I mean, this is the first test of the 20-day moving average we've seen. We've been holding that rising 10-day moving average. Now we're testing that 20-day moving average in this prior little level of resistance, which was support here as well. So, you know, maybe gold is a buy in here. It's not my style to buy on weakness like this. But you know, you look at the 1 minute time frame, we're still below the daily VWAP. So you know, gold is still in a major uptrend. I don't think calling for a top in gold makes any sense at all. It's had a hell of a run. It's probably due for some congestion, but you know, this is just a normal pullback within an uptrend. There's nothing here to be concerned about. Big volume, sure. But you know, we're holding this prior level. Maybe if we start to rally up a little bit and that 5-day moving average becomes resistance, then we look at it a little bit more carefully. But for now, for a longer term trade, you know, investment, you know, the trend is clearly still higher in gold. There's nothing here that suggests the end of gold. It's had a heck of a rally, so you know, digestion of these gains makes a lot of sense in here. Oil, you know, I look at the USO. Oil's been pretty neutral to slightly downtrend here over the last 2 months. It's broken this trend in here, but popped back in quickly into this channel. We've got a rising 50-day moving average, and on the weekly time frame, we've got a much more bullish pattern. If the market can bounce here, I think oil needs to get probably back above, you know, at this point, probably back above 40 or so. And then maybe we start to see some recovery in the USO, but right now it's just not giving us any reason to get overly concerned. Let's take a look at some of the leading stocks, because people like to talk about those. Amazon has a price target of 200, north of 200, I understand, so just continue to hold that one. You've got 65 more points left. But realistically, Amazon's experiencing a pullback. I mean, since the earnings, the stock gapped up. It ran just a beautiful consolidation there above the rising 10-day moving average. And now we're getting a little bit heavier volume the last couple of days, so maybe a little bit of a consolidation in here. Looks like about 133 should be some support for Amazon. It's had a great rally, so I mean, there's going to be natural profit taking that occurs, but this stock is at all-time highs, and you know, one of the most bullish things a stock can do is trade at new highs. You know, and same, you know, similar to gold, I guess. Apple still in an uptrend. I had seen the guys from Bespoke Investment who do a great job. They were mentioning that that Apple came close but didn't reach a new record, which was for the number of consecutive closes above the 50-day moving average, so days above the 50-day moving average. And you can see it's going to close below the 50-day moving average, and that's going to get a lot of people short. And you know, for short-term trades, then I think that short is probably is probably due for some consolidation. But more important than where we are in relation to the 50-day moving average is what's the direction. You know, the direction of the 50-day moving average is higher, so I think that there will be a bounce back, probably up towards the $200 level, maybe even next week. But Apple's still in an overall, you know, huge uptrend. The market's just a little bit tired here. It's the end of the year. People are taking time off, taking some profits, and that sort of thing. You know, Google still in a huge uptrend, obviously, as well. You look at that weekly time frame. People have been looking for reasons for, you know, the levels of resistance. You know, people were saying this was going to be the area that, or this was going to be the area where it stopped, and they said this was going to be the area. Now they're saying this is going to be the level. Let's let the stock decide. We're still in a strong uptrend overall. You know, it's not my style of stock to trade, but if I was forced to trade it, you know, on a day-to-day basis, it's in an uptrend. My bias would be long, but not on a day, obviously, where we break below the daily VWAP, and there was a great short selling opportunity in there as well. Look at, you know, some of the, you know, I saw a lot of chatter this week on AIG. I'm not trading on AIG because I can't find the shares to short, but it's, you know, it's clearly broken right in here. You'd seen where it broke an important level of support. It got that big move down to the 200-day moving average. Now it's trying to consolidate there. Will it bounce from the 200-day moving average? you know, if it does, probably not be much beyond this prior level of support, so it's not a good buy candidate, I don't think. By the way, if you guys got anything you want to take a look at in the last 5 minutes, we'll go ahead and do that. So you can type those in, and so Snoopy's buying a bunch of gold stocks in the DGP, and that's his style. So, you know, Joe's got a longer term approach. I see him taking some 30–40% gains and that sort of thing. So, you know, you got to do what's right for you, and you know, trim them when they get going. You know, well, let me talk about the shippers for a minute, because, you know, this group, a lot of people were getting, you know, chasing the performance in the shippers a couple of weeks ago. I've been watching for the pullback. It came down to this prior resistance. That resistance it did bounce from, but here on the 10-minute time frame, it's, you know, this 1650 level is like 111.80. It just can't get up through it and hold above it. It just keeps getting rejected there. So and now this prior support, we've got it broken at 16. So I think these shippers still need some time to heal. Unfortunately, I thought this week was going to set up a good week for the shippers. EXM is another one that I've been keeping an eye on. It's just consolidating here. It's not, you know, it's not hurting anyone badly, but, you know, we still have lower highs in here, and we've got these lower lows now below the declining, below the flat 5-day moving average. I think you need to at least take out about 735 before EXM becomes a buy, and then that GNK. GNK is another you know, big liquid shipping company. Broke that resistance, had a false breakdown here. Now it's trying to hold that $24 level once again. And we can see diminishing volume, which is good to see, relative to that green candle where we had advancing volume. So we'd seen advancing volume on the up move, you know, expanding volume, and then lower volume on this consolidation. But when you drill down and take a look at it, do you want to buy this thing? The answer is no, because, you know, we got above that 5-day moving average, which was still declining. We were watching it in here. It didn't get beyond this level, so there was no reason to buy. And now we're stuck below this 24.25. So still need some consolidation in the shippers before we're, I think, able to take a look at those from the long side. And, you know, maybe they're going to recover next week. I think they're definitely worth keeping an eye on. But I'll go ahead and take your question.